How to invest in the stock market as a beginner. So I was once a beginner, and I can tell you when I first started, I was very nervous. I didn't know much of what I was doing. And honestly, what helped me was just watching a lot of videos like this, taking notes, doing my own research, stuff like that. So in order to understand how to invest, you need to understand what the stock market is. So the stock market is basically the economy 6 months ahead. So if you think about it, investors are always forward looking, and you have to be that way if you're an investor because you're investing for the future potential in a company rather than what's happening right now. It's also a place where your money makes you more money, and this is called compound interest because you're earning off of the money you already made, and then that just compounds over time. That's why you hear people have become millionaires in the stock market. It's not because they put $1 million into the stock market. It's because maybe they put 100,000, but their returns kept compounding over time. It's also a place where companies sell parts of their ownership, these are called shares, to the public in exchange for money. So for example, when you buy shares of Apple, you own a very, very small portion of Apple, and you actually become an owner in Apple. So here's just an example of how investing can actually change your life. So if you put $100 a week into the S&P 500, and the S&P 500 is the 500 largest companies in the US by market cap. So that just means the share price multiplied by the total number of shares that that company offers. And remember, share is a portion of a company that you own, a very, very small portion, and then whatever that stock price is, that's the market cap. So like Apple and Amazon, they have some of the biggest market caps in the world, while companies like Cheesecake Factory has a much smaller market cap. So after 30 years, if you would have done that, you would have over $940,000. And after 31, it was a million. But if you only saved that, you would have 155,000, which is still a lot of money. But you also have to factor in what inflation could do to that. So you would actually be losing money, right? Because the whole point of investing is really to beat inflation. And inflation on average compounds about 2% a year, even though it's been much higher in recent years. But that means that you would have missed out on $784,000 just from you buying into the S&P 500. You don't even have to do any research. You just buy into this fund. And you're probably thinking, okay, well, how do I do that? So these are the basically most popular investment platforms out there. Now, Charles Schwab and Robinhood are both FDIC insured. That means if either of these companies ever went bankrupt, you would get $250,000 back. But with Fidelity, their investment accounts aren't FDIC insured, but their cash is. So if you had like $250,000 in cash with Fidelity, which means that you wouldn't have it invested in the stock market, but you would just have it sitting in that account, that would be FDIC insured. But the Charles Schwab and Robinhood are both investment FDIC insured, which just means up to $250,000 you get guaranteed back if either of any of these companies went bankrupt. So Robinhood is one of the most beginner friendly apps that people use. There's not as much investing platform like research you can do with it though. Like for something with like Charles Schwab, they actually have like stock analysis tools and like search bars. They even have like some value ratings on companies. But Charles Schwab and Fidelity have pretty much been around for a long time. So for the investing accounts, there's some taxable and untaxable accounts. So just what's called the standard brokerage account, this is available to anyone that's 18 and older. And if you're younger than that, then you can have an adult open a custodial brokerage account for investors that are under 18. And there's also no contribution limit. Now, 401k, you've probably heard of this. This is a retirement account. Now, this might be offered by your employer, and if it is, it has to be available to all employees 21 and older who have worked for that company at least a year. Now, the contributions are not taxed, and your investments grow tax-free until you withdraw them in retirement at the age of 59 and a half. That's the catch. You can't access the money in this account until age 59 and a half. And then when you actually take it out, it'll be taxed at your current income tax rate. Now, the contribution limit is $23,000 annually. So you can't put any more than this. If you do, you can actually get some penalties and you might have to pay even more on taxes. So always watch out for that. If you ever have a 401k or any of these other retirement accounts, make sure you don't exceed the limit. The next one is a Roth 401k. This is also a retirement account. So this is when the contributions you make are already taxed. But what this means is that your investments grow tax-free, and once you reach the age of 62 and a half, you're able to withdraw these funds from your Roth 401k without having to pay income taxes as long as you made your first contribution to the account at least 5 years before. And the contribution limit is $23,000. And then the traditional IRA, you've probably heard of this too. This is also a retirement account, and this is available to anyone who earns an income. So the contributions grow tax deferred, then you pay taxes on your withdrawals in retirement, 59.5, at your current tax bracket, and the contribution limit for under 50 is 7,000, and if you're over 50, it's 8,000. So it can all seem complicated with these retirement accounts, but basically all you have to know is that there's a limit to how much you can put into these retirement accounts. So they're designed to not be withdrawn from until you reach retirement age. Now, if you don't plan on retiring until these ages that they have set, then this might actually be a really good way for you to go. But say if you wanted to put even more than these limits, you could actually open like a brokerage account and put money into there. Of course, it will be taxed, but the pro is that you can withdraw whenever you want, and you won't have to pay a penalty for that except for taxes. So another thing that you'll hear in the stock market is what's referred to as the market, and this refers to the S&P 500. Now the S&P 500, as I previously touched on, it's the 500 largest publicly traded companies in the US. Now a public company is just a company that trades on the stock market, and it's primarily weighted by market cap. Remember, that's the share price times the number of shares. And many people have only invested into the S&P 500 and they've retired millionaires. And the S&P 500 has outperformed a whole lot of actively managed funds over the long term. And it's also just one of the easiest ways to invest because it doesn't really require much research, as I'll get into later in the video. All you really have to do is just stay consistent with your investing. Now, index funds are investments that mirror the performance of an index like the S&P 500. So index funds often have lower expense ratios. Expense ratios just refer to fees, and because they are passively managed, actively managed funds have higher expense ratios since people are making active investment decisions. So index funds can actually give you much higher returns than actively managed funds. So dividends are payments that a company makes to shareholders for owning their stock. So this is basically giving the investors income for just hanging on to the stock. You don't have to do anything. It's basically like passive income. Now this is often paid quarterly. Some companies pay semi-annually, so that'll be twice a year. And then the dividend yield is the percentage of a share price that's paid on a yearly basis. Now, instead of paying dividends, many companies invest their earnings back into the company to basically return capital appreciation, or just share price appreciation, right? So that's when the stock goes up. They're returning that to the shareholder instead of paying them for owning the stock. Now, an ex-dividend date is a day when the dividend eligibility for the dividend, right, to receive the income, you have to hold that stock on the day before that because they count everyone's shares on that day, the ex-dividend date. So you need to be a shareholder before that date. Now, some common terms that you'll hear in the stock market is a bear market. This is a period in which prices are expected to fall. So this often means major indexes like the S&P 500. Sometimes you'll hear about the NASDAQ or the Dow. That's when basically these decrease by 20% or more compared to their previous highs. Now, a bull market is just the opposite. It's when prices are expected to rise. And an initial public offering is a previously private company that becomes public by selling stock shares on the stock market. So it's just a company that decides to be traded on the stock market to raise money from investors to help grow their business, right? That's the whole point of every company on the stock market. Now, in earnings per share, or you'll hear EPS for short, is a company's profit divided by the number of shares that they have. This is a very important factor for determining companies' profitability, and you'll hear about this on pretty much every earnings that companies report because they report that 4 times a year, and they report their top and bottom line. So they report their revenue and their EPS. So if a company beats their revenue and EPS, you'll hear investors say, oh, they beat on the top and bottom line. It basically just means that they had a really good earnings because they beat their estimates. Now, the price to earnings ratio, or the PE ratio, is another important term that you'll hear. This is used to value a company against its peers. So this is the stock price divided by the earnings per share. So you want to have a low PE ratio compared to the industry that your company that you're looking at is in. So for example, if you were valuing a tech company, well, you would want to compare it to all the tech companies' PE ratios, or a lot of them, and to see how they're stacking up against their competitors. And a low PE ratio can signal a better opportunity. Now, some types of stocks are blue chip stocks. So these are large, well-established, and financially stable companies with a history of reliable performance. Right, so I'm sure the first one that popped into your mind was Apple, or maybe it was Google, or maybe it was Microsoft, Amazon. All these companies, they're not really going to go anywhere. I mean, they're pretty much going to perform in every economic environment. So these are blue chip stocks. Now, dividend stocks are companies that regularly pay dividends, and these are financially stable. So they're similar to blue chip stocks, except they pay dividends. So they give you income. And you can also reinvest the dividends that you receive to actually exponentially increase your returns over time, because that dividend that you reinvested earns more dividends because of that dividend. And then the cycle just repeats. Now, growth stocks are stocks that are expected to grow faster than the market average. So these have high risk, but they have high reward. And then defensive stocks are companies that are in industries that tend to do well during economic downturns, like healthcare, utilities, and consumer goods. Now, some things that I wish I knew when I first started investing was don't base buying and selling decisions off of emotions. That's how a lot of the short-term price actions or just short-term fluctuations in the stock market happen. It's fear and greed that drive the stock market in the short term. You'll hear the term FOMO a lot, fear of missing out, because say a company is going up a lot and then your portfolio hasn't been doing good, well, you might FOMO into that stock, right? So you put a lot of money into that stock, but then that stock actually tops, and then it actually starts coming down. So instead of basing your decisions off of emotions, base them off of what's truly happening with the companies you're investing in. If no bad news came out and the stock actually goes down, that might actually be a good opportunity to buy. Another thing that I wish I knew was time in the market over timing the market. This is a very famous quote on Wall Street or just in the stock market in general, and it's true. I mean, it's very hard to time the 10 best days in the stock market over like the past 20 years. And if you would have missed those 10 best days, I mean, your returns literally would have been cut close to half. Another thing is to buy companies because of their fundamentals. You know, don't chase a stock because your friend told you to buy it. You should be investing in stocks because they have good cash flow, because they're growing their revenues, because their valuation is actually much lower than their peers. It's things like that that you want to base your decisions off of, not because your friend told you to buy this stock. Also, don't get attached to companies you own. You might own some stocks and they've actually performed very well, but if their business model and their fundamentals are just actually coming down and they're, declining revenue, all that kind of stuff, then it might actually be a good time to get out of that stock. Another thing to do is to be diversified. You don't want to have all your eggs in one basket in the stock market, especially in the stock market. You might want to own some blue chip stocks, some dividend stocks, maybe even some growth stocks. It all depends on your time horizon and how much risk you're willing to take. Obviously, the higher risk, the higher reward, but the lower risk, the lower reward, but the lower your portfolio will fluctuate. Another thing to do is to be patient. You might own some great companies, and they actually might be going down just because of short-term news, because of short-term noise. But if their fundamentals have not changed and they're just great, sound companies, like for example, Amazon, if Amazon dipped 10% tomorrow for no reason, then I'm going to buy Amazon because it's a great company that's going to perform well in the future. Another thing I wish I knew was just to stay updated. You know, you can buy companies, maybe research them for a couple of days, and then make your buying decision off of that. But if you don't actually monitor what's going on with the company, if you don't actually review their earnings statements, you know, listen to conference calls, all that kind of stuff, then you might actually be doing yourself harm. So just stay updated on your companies you're invested in. You can read some articles, even the Charles Schwab platform, they have a daily market update on what happened on that date. Yahoo Finance also has great articles on that kind of stuff. Really, any kind of financial news website. Now, just some things that will really separate you from the average investor. You know, read company earnings. It's really good to just understand how to read balance sheets and income statements and cash flow statements, all that kind of stuff. And there's so many resources to just understand that stuff. Another thing that'll separate you is to listen to conference calls. No one wants to listen to conference calls. It's boring, it's not fun, but it's a great way to just listen to management's outlook. It's a great way to just understand, like I said with the earnings, just to be updated on what's going on. They tell you, you know, about what they're projecting, what their future plans are, all that kind of stuff. Another thing is to understand that news drives the market in the short term, but fundamentals drive the market in the long term. Like for example, a company might come out and have like a little partnership with another company. They might have like a brand deal, maybe like make a commercial together. Maybe that drives the stock up, you know, at 1% or something like that. But if that company came out and they reported profitability for the first time, well, that is one of the reasons you would want to invest in them. Not because they made a short-term deal, which is still good, but because that's fundamentally changing for the company. Now they went from unprofitable to profitable. You can look at more assets than liabilities. You can look at short-term cash able to pay off current liabilities. You just want to be invested in companies that have good fundamentals. Another thing is just don't chase trends, but invest in what is actually going to give you those returns in the long run. Remember, investing is a patient game. If you have patience, you're going to have higher reward. It's almost a guarantee in the stock market. Every single dip in the S&P 500 or the market has been a buy. Every single one. The financial crisis in 2008, COVID, Russia and Ukraine, all of it, it's all been buying opportunities. And I hope you guys found some value in this. None of this is financial advice. I'm just giving my perspective on what I've learned in the stock market so far. And, you know, it just takes consistency. The more consistent you are with investing, the longer you do it, the better you're going to be. Everyone was once a beginner, even Warren Buffett. Thank you for watching. J Money out.